Did you know there's a hidden financial system operating behind the scenes, influencing everything from your mortgage rates to your retirement savings? It's called shadow banking, and while it might sound like something out of a spy movie, it's very real and it could be impacting your wallet more than you realize. Today, we're pulling back the curtain on the invisible economy to uncover how shadow banking works and what it means for you. So, what exactly is shadow banking? Unlike traditional banks that take deposits and make loans, shadow banking refers to a network of non-bank financial institutions that provide similar services, like lending, investing, and credit, but operate outside the regulatory framework of traditional banking. Examples include hedge funds, private equity firms, money market funds, and even some fintech companies. These entities play a crucial role in the global financial system, providing liquidity and credit where traditional banks can't or won't. But here's the catch: because they're not subject to the same regulations as banks, shadow banking can be riskier and less transparent. And when things go wrong, the consequences can ripple through the entire economy and your wallet. How shadow banking impacts you. Now, you might be wondering, how does shadow banking affect me? Let's break it down. Access to credit. Shadow banking often fills gaps left by traditional banks, providing loans to individuals and businesses that might not qualify otherwise. This can make it easier to get a mortgage, car loan, or small business loan, but often at higher interest rates. Investment opportunities. Many shadow banking entities, like hedge funds and private equity firms, manage investments that can impact your retirement savings or pension funds. If these investments perform well, you benefit. If they fail, your savings could take a hit. Economic stability. Because shadow banking operates with less oversight, it can contribute to financial instability. For example, the 2008 financial crisis was fueled in part by risky shadow banking practices. When the system falters, it can lead to job losses, market crashes, and tighter credit conditions, all of which affect your wallet. Innovation and competition. On the flip side, shadow banking drives innovation in the financial sector. Fintech companies, for example, often operate in the shadow banking space, offering new tools and services that can make managing your money easier and more efficient. Let's look at some real-life examples. Take Sarah, a small business owner who couldn't get a loan from a traditional bank. She turned to a peer-to-peer lending platform, a form of shadow banking, and secured the funding she needed to grow her business. Or consider John, whose retirement savings were invested in a hedge fund. When the fund made risky bets that paid off, John's portfolio grew. But when the fund suffered losses, so did his savings. These stories show that shadow banking can be both a blessing and a curse, depending on how it's managed. The risks of shadow banking. Of course, shadow banking isn't without its risks. Here are some of the biggest concerns. Lack of transparency. Because shadow banking operates outside traditional regulations, it's harder to monitor and control. This lack of transparency can lead to risky behavior and hidden vulnerabilities. Systemic risk. Shadow banking is deeply interconnected with the traditional financial system. If one part of the shadow banking system fails, it can trigger a domino effect, destabilizing the entire economy. Consumer protection. Without the same safeguards as traditional banks, consumers may be more vulnerable to predatory lending, fraud, or other abuses. Regulatory gaps. While regulators are working to address these risks, shadow banking is constantly evolving, making it difficult to keep up. So, while shadow banking plays an important role in the economy, it's essential to approach it with caution and awareness. How to protect yourself. Ready to protect yourself from the risks of shadow banking? Here's how. Do your research. Before working with a non-bank financial institution, research its reputation, track record, and regulatory status. Look for reviews, ratings, and any red flags. Diversify your investments. Don't put all your eggs in one basket. Spread your investments across different asset classes and institutions to reduce risk. Stay informed. Keep up with financial news and developments, especially those related to shadow banking and regulatory changes. Use regulated institutions. Whenever possible, work with traditional banks or regulated financial institutions that offer greater transparency and consumer protections. Consult a professional. If you're unsure about a financial product or service, seek advice from a trusted financial advisor. By staying informed and cautious, you can navigate the invisible economy without putting your wallet at risk. Shadow banking is a powerful but often overlooked force in the global economy. While it can provide opportunities and innovation, it also comes with risks that can impact your wallet. By understanding how it works and taking steps to protect yourself, you can make smarter financial decisions and safeguard your future. Until next time, stay curious, stay informed, and stay financially savvy.